So far, we have covered short-term funding, but corporate issuer also uses long-term debt for stable funding of short-term activities and long-term investments. Note the stable funding, because if it's a short-term debt, the corporate issuer will have the problem of rollover risk. An example of long-term investment could be purchase of equipment or factories. Credit quality differences lead to varying features. Investment grade issuers have strong cash flow capacity to meet fixed obligation. So investment grades are considered having less credit risk and also is able to borrow at a lower interest rate. While high yield issuers are more vulnerable in between debt payments, resulting in a higher interest rate. Credit quality becomes more critical for longer maturities due to increased financial distress risk over time. Makes sense because as the maturity of the debt increases, the higher risk of a credit default. Investors often accept investment grade IG bonds with few or no restrictive covenants because they are of a higher credit quality and a lower risk of default. For IG issuers, they have more flexibility in managing debt, but this is obviously not the case for high yield issuers. For IG bonds, they are relatively standardized debt instruments. Issuers usually stagger their debt maturities to minimize refinancing risk, also known as the rollover risk. And the investment grade issuers have the ability to raise additional debt based on market conditions. Because of their high credit standing, they have the flexibility of issuing debt on pretty much any kind of market conditions. But for high yield issuers, because of the higher expected likelihood of financial distress, the interest that they pay will be higher. And also the yield to maturity, in this case is the interest, can be attributed more to the issuer specific spread than the overall benchmark yield and IG debt. This line means that for the IG debt, the interest rate that they pay will be just a little bit higher than what the government bond is paying. So depending on the term of maturity, for example, a 5-year bond, the investment grade will be a little bit higher than a 5-year. But for high yield issuers, because the credit spread is a lot more significant, it could be many times higher than the government rate. For example, during the very low interest rate era, where, for example, a 1-year bond could be just less than 1%, but for a high yield issuer, they might borrow at an interest rate of 3 or 4 or even higher percentage. So now the benchmark yield will no longer be that significant, and most of the interest is comprises of the credit spread, is what I was trying to say here. And these high yield bonds are more equity-like with uncertain cash flows. The uncertainty of the cash flow is due to the bonds being callable. We shall see that later. Because there is a potential of a default, high yield issuers, they need to specify secondary repayment sources. Secondary repayment sources refer to alternative assets or collateral that can be used to repay the lender in case that the primary source of repayment is insufficient. Because of the higher credit risk, investors impose more constraints on the high yield issuers due to the higher default risk. The constraint is in the form of debt covenants, and these are listed in the bond indentures. Because the interest rate is so high, high yield issuers prioritize financial flexibility with prepayment options or bonds with callable features. So this is the part that I was talking about earlier with the unexpected cash flow, because now you have callable bonds, so the lenders would have a reinvestment risk. Callable debt allows issuers to redeem the bonds before maturity at a predetermined price. For instance, this VIDU issued a 6.5% callable debt after 3 years at 103.25% of the principal. Because of the ability for the issuer to call the bonds, the interest rate would be higher. Callable debt is attractive to issuers because when their credit rating improve, they can call the bond back when borrowing cost decreases. From the investor's perspective, if the issuer's credit spreads tighten, the bond will increase in price. So the investors will stand to gain in a credit issuer improve. But usually the case, as said earlier, the bonds come with a recall option. So the gains are limited to the call price. Which means that the maximum price will be the strike price of the call option. If the bond price were to go higher than the strike price, the issuer will just call the bond back. So this is the part where say that the value of the call option will increase, and this would be attractive to the issuer. So to rephrase it, when the credit ratings improve for the high yield bond issuer, it would benefit the investor such that the bond price would increase. But if the bond price were to increase too much, the call option would increase in value. And if it goes above the strike price, it will be beneficial to the issuer because they can call back the bond and then reissue a loan at a lower interest rate because of the improved credit rating. So in a way, it kind of benefit both parties.